If I were to characterize 2023 in one word, it would have to be resilience. Looking back on the numerous shocks the world has encountered over the last few years, from the pandemic, the various geopolitical crises, and the resulting macroeconomic conditions that followed, it's fair to say the global economy has done relatively well, and this is particularly true for the U.S. economy. But as I look towards the coming year, the one word that comes to mind for 2024 is divergence. And I'm going to focus on three areas where I think divergence will come into play this year. The first, central bank policy divergence. Over the last few years, central bank policy around the world has largely been in sync, with over 90% of all central bank decisions moving in the same direction. In 2020, central banks around the world cut rates and then pivoted in 2021 and 2022 when central banks started to tighten rates due to inflationary pressures. So while central bank policy has been uniform, global growth around the world has not. The IMF expects global growth to slow to 2.9% in 2024, with widening divergence between regions and countries, with stronger growth projected in the US and larger emerging market economies, while China and the Euro area are expected to struggle. So different economic prospects will likely lead to different monetary policy paths for central banks. And we have started to see this occur in 2023, but I think this divergence will be much more pronounced in 2024. In addition to economic growth, a country's fiscal policy, exchange rate regime, inflation outlook, and trade dependencies all have the potential to impact central bank policy. The second is market expectations and Federal Reserve projections on interest rates.
We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not.
In December, the Fed released projections anticipating 325 basis point rate cuts to the Fed funds rate in 2024. However, currently the market is much more dovish, pricing in 150 basis point cuts for the year, double the Fed's projections. So the pivot from the Fed in December did boost U.S. stocks and did send Treasury yields tumbling. Since October, yields on the U.S. 10-year declined by more than 100 basis points from their peak. Riskier assets have performed particularly well, with spreads narrowing, and the U.S. stock market reached near record highs during the final week of 2023. However, if market expectations end up being overly optimistic, you would likely see a market correction along with a heightened degree of market volatility, with volatility being exacerbated during releases of macro news or Fed speeches suggesting that higher rates were more likely. So we should definitely keep our eye on this divergence in expectations for future interest rates, given the potential negative impact it could have on markets. And finally, I'm looking at political policy divergence. There will be a number of high-profile elections in 2024 that include presidential elections in the US, Taiwan, Indonesia, the UK, and Mexico. Additionally, key legislative elections will also be held during the year. In total, countries in which these elections are being held account for approximately 40% of the world's GDP. And it's important to keep in mind these elections are happening at a time of heightened economic uncertainty, a precarious geopolitical environment, and a high degree of political polarization. This high degree of political polarization brings with it the potential for radical changes in both economic and political policy that could diverge from its current path. The changes have the potential to not only impact the country, but also have a wider global reach. For example, the outcome of Taiwan's vote at the start of the year could set the tone for U.S.-China relations for this year.